I'm May, and this is May Retires. If you have incentive stock options from an employer, the kind many pre-retirees accumulated over a long career at a single company, there is a tax you can owe on money you haven't actually received yet. Not a projection, not a paper loss, an actual tax bill due by April. On paper, gains that could evaporate before you ever sell the stock. It's called the Alternative Minimum Tax, or AMT, and it has a specific, brutal application to incentive stock options that catches pre-retirees who are finally exercising options they've held for years as they approach retirement. Here's the trap. Exercising an incentive stock option and holding the shares, rather than selling immediately, can trigger AMT on the paper gain, even though you haven't sold a single share and have no cash from the transaction to pay the tax with. Today, I'm going to show you exactly how this landmine works, a real example of the cash flow trap it creates, and the moves that can help you avoid triggering a tax bill on money you don't actually have. The alternative minimum tax is a parallel tax system that runs alongside the regular tax system, designed originally to make sure high earners couldn't reduce their tax to near zero through deductions and preferences. You calculate your tax both ways, regular and AMT, and pay whichever is higher. Incentive stock options get special treatment under regular tax rules. If you exercise and hold the shares for the required period, you may owe no regular income tax at exercise, only capital gains tax later when you sell. But under AMT rules, the spread between your exercise price and the stock's fair market value at exercise is counted as income immediately in the year you exercise, whether you sell or not. Pre-retirees who've worked at a single company for decades often have large blocks of incentive stock options granted years ago at a low strike price. As retirement approaches, many decide to finally exercise these options, sometimes to diversify out of a concentrated position, sometimes because the options are expiring. If they exercise and hold the shares, intending to qualify for favorable long-term capital gains treatment later, they can trigger a massive AMT bill in the exercise year based purely on the paper spread, even if the stock later drops in value. A pre-retiree has incentive stock options with a strike price of $10 per share. The stock is now trading at $60. They exercise 5,000 shares, paying $50,000 to acquire stock now worth $300,000, a paper spread of $250,000. For regular tax purposes, if they hold the shares, they owe nothing yet. But for AMT purposes, that $250,000 spread counts as income in the year of exercise. Even after AMT exemptions and adjustments, this can generate an AMT liability of $40,000 to $60,000 or more, depending on their other income, due by April, on stock they still own and haven't sold. If the stock price then drops before they sell, which happens more often than people expect with concentrated single company positions, they can end up having paid tax on a gain that no longer exists. There is a mechanism called the AMT credit that can help recover some of this in future years, but it doesn't help with the immediate cash flow problem, and full recovery can take years. The advice to exercise and hold for a year to get long-term capital gains treatment is genuinely sound tax advice in the regular tax system. The AMT trap is that this exact strategy, the one that sounds smartest, is precisely what triggers the immediate AMT liability. There's no warning on your pay stub or option grant paperwork that flags this. Move 1. Run the AMT calculation before you exercise, not after. Before exercising any meaningful block of incentive stock options, calculate the projected AMT liability based on the current spread between strike price and fair market value. This is a standard calculation your CPA or a tax software with AMT modeling can run in advance. The mistake is doing this calculation in March of the following year instead of before the exercise. Move 2. Exercise in smaller tranches across multiple years. Rather than exercising your entire incentive stock option grant in one year, Spreading the exercise across 2 or 3 years can keep the AMT spread in each individual year below the threshold where it triggers a liability, or at least significantly reduce the size of the bill in any single year. Move 3. Consider an exercise and sell, also called a disqualifying disposition, for at least part of the position. If you exercise and sell in the same year, rather than holding, you lose the favorable long-term capital gains treatment on that portion, and it's taxed as ordinary income instead. But you also avoid the AMT trap on that portion entirely, and critically, you have actual cash from the sale to pay whatever tax is owed. For pre-retirees managing cash flow into retirement, this trade-off is often worth serious consideration rather than automatically defaulting to exercise and hold. Common mistakes people make trying to avoid this. Mistake 1. Exercising a large block in a single year without modelling the AMT impact first. Mistake 2. Exercising and holding with no plan for where the cash to pay the AMT bill will come from. Mistake 3. Not tracking the AMT credit in subsequent years, leaving money on the table that could offset future regular tax liability. Here's your action item this week. If you're holding incentive stock options and considering exercising any of them before retirement, do not exercise a single share until you or your CPA have run an AMT projection based on the current spread. This is a 5-minute conversation that can prevent a 5-figure cash flow surprise. The checklist. Identify the total spread, fair market value minus strike price, across your incentive stock option grants. Run an AMT projection before exercising any shares. Consider spreading exercises across multiple tax years. Evaluate exercise and sell for at least part of the position to generate cash for any tax owed. Track your AMT credit carry forward in subsequent years. This isn't a rule the IRS hides. It's published, well documented, and has existed for decades. It catches people because the strategy that sounds smartest under regular tax rules is the exact strategy that triggers it under AMT rules. If that is valuable to you, staying in the loop through the email list gets you these breakdowns as soon as they are ready. And if you ever want to help keep the lights on around here, there is a Buy Me a Coffee link in the description. No pressure either way. I just wanted you to know it is there next week. I'm covering the Social Security tax torpedo and why claiming at 62 could cost you more than you think. I'm May. See you in the next one.